If you are planning to buy a home this year, or if you already have a mortgage and you think you are getting a fair deal, stop whatever you are doing right now because the strategies that worked even 2 years ago are actively costing Americans thousands of dollars in 2026. The mortgage market has shifted in ways that banks and lenders are absolutely not advertising, and the gap between what an uninformed borrower pays and what a strategically prepared borrower pays has never been wider. We are talking about a difference of $40,000 to $60,000 over the life of a typical loan. That is real money leaving your household, real retirement savings that never get funded, and real financial freedom that gets pushed further away. So if you were thinking about clicking off, understand that what you are about to learn is the difference between a mortgage that slowly drains your wealth and one that actually accelerates it. Let us start with something called rate lock float down provisions, because this is one of the most powerful tools available to a borrower in 2026, and almost nobody talks about it. A rate lock is something most people have heard of. You apply for a mortgage, the lender gives you an interest rate, and they lock it in so that even if rates rise before your closing date, you are protected. That part most people understand. But what the bank is not going to volunteer to tell you is that many lenders offer what is called a float-down option embedded within that rate lock, which means that if interest rates fall after you have locked your rate, you can capture that lower rate before you close. Without a float-down provision, you are locked into your rate whether it goes up or down. With one, you get protection on the upside and participation on the downside. The typical float-down provision allows you to drop your locked rate one time if market rates fall by at least 0.25 percentage points below your locked rate before closing. On a $400,000 loan, a 0.25 percentage point reduction translates to roughly $18 per month in savings, which does not sound dramatic until you multiply it by 360 months and realize you just saved $6,480. The action step here is simple, but requires you to be proactive. When speaking with any lender, ask them directly whether they offer a float-down provision, what the fee is, and what the threshold is for triggering it. Some lenders charge between $200 and $500 for this option. Others bundle it in for free as a competitive move to win your business. If a lender charges you nothing for a float-down, that is a lender who is actively competing for your loan. The broader point is this: you do not have to choose between rate certainty and rate opportunity. In 2026, the smartest borrowers are demanding both at the same time. Now let us talk about your credit score, because this is where most people make a mistake that costs them dearly before they ever walk into a lender's office. The concept is called the mortgage credit score, and it is fundamentally different from the consumer credit score you see on free apps and credit card dashboards. Most Americans check their credit using a model called Vantage Score, or FICO Score 8, which is what credit card companies and auto lenders use. But mortgage lenders in the United States use a different set of FICO scoring models, specifically FICO Score 2, FICO Score 4, and FICO Score 5, which pull from Experian, TransUnion, and Equifax respectively. These older models weight certain factors differently, particularly your payment history on installment loans and the age of your credit accounts. What this means practically is that your score on a free monitoring app might show 720, but your actual mortgage credit score could be 705 or even 690. And that difference matters enormously because lenders tier their interest rates based on credit score bands. The difference between a 699 credit score and a 700 credit score at many lenders is a rate adjustment of 0.25 percentage points. On a $350,000 loan over 30 years, that single point difference is worth approximately $18,000. 1 point on your credit score, $18,000 out of your pocket. Here is what the most financially savvy borrowers are doing right now. They are pulling their actual mortgage credit scores at least 6 months before they plan to apply, giving themselves time to correct any issues on those specific reports. You are looking for collection accounts, late payments from the past 24 months, or high utilization on revolving credit. Utilization is the percentage of your available credit limit that you are currently using, and on mortgage scoring models, you want that number below 28% on each individual card. If you have a card with a $5,000 limit and you are carrying $2,000, that is 40% utilization, and it is suppressing your mortgage score. Pay that card down to $1,399 and your utilization drops below the threshold. Do this across every card you carry a balance on, and you could see a mortgage score improvement of 15 to 30 points within 60 days, which could move you into a better rate tier and save you $20,000 to $30,000 over your loan term. The gap between what a borrower pays at a score of 680 versus a score of 760 can be as much as 1.5 percentage points in interest rate. On a $400,000 30-year fixed mortgage, 1.5 percentage points is the difference between a monthly payment of $2,386 and a monthly payment of $2,661. That is $275 every single month, $3,300 every year, and $99,000 over 30 years. Credit preparation is not a minor hygiene task. It is one of the highest return investments you will ever make, and it costs you nothing but time and attention. Let us move to loan-to-value ratio, which lenders abbreviate as LTV, because this number controls more of your mortgage cost than almost any other factor, and most buyers dramatically underestimate its importance. Your loan-to-value ratio is simply the size of your loan divided by the appraised value of the home. If you are buying a home worth $400,000 and putting down $80,000, your loan is $320,000 and your LTV is 80%. The reason this matters so much is that lenders price risk using LTV as one of their primary variables. The lower your LTV, the less risk the lender takes on, and the better the rate and terms they offer. The critical threshold every buyer needs to know is 80% LTV, because at 80% or below, you eliminate private mortgage insurance entirely. Private mortgage insurance, called PMI, is an additional monthly fee lenders require when your down payment is less than 20% of the home's value. PMI typically costs between 0.5 and 1.5% of the loan amount annually, which on a $350,000 loan is between $1,750 and $5,250 per year. That is between $146 and $438 added to your monthly payment every single month, and you receive absolutely nothing of value in exchange because PMI protects the lender, not you. But here is what most people do not realize. If you purchased a home with less than 20% down and property values in your area have appreciated, you may already be at or below 80% LTV right now without putting in a single additional dollar. In markets where home values have risen 15 to 20% over the past 3 years, millions of homeowners paying PMI are eligible to request its removal today. Contact your loan servicer and request an LTV assessment. If your home's current appraised value puts your outstanding loan balance at 80% or less, you can request PMI removal in writing. The lender may require a formal appraisal costing between $350 and $600, but if that appraisal confirms you are at or below 80% LTV, you eliminate a monthly fee that could be worth hundreds of dollars indefinitely. That $400 appraisal could save you $50,000 over the remaining life of your loan. Now let us talk about debt-to-income ratio, which lenders abbreviate as DTI, because this is the single most important qualifying factor that determines whether you can get a loan and how much you qualify for. Your DTI is calculated by adding up all of your monthly debt payments and dividing that total by your gross monthly income before taxes. Monthly debt payments include your proposed mortgage payment with principal, interest, taxes, and insurance, plus any car payments, student loan payments, minimum credit card payments, and any other recurring obligations. If your gross monthly income is $7,000 and your total monthly debts including the new mortgage would be $2,800, your DTI is 40%. Here is the number you need to know. Conventional loans will typically allow a maximum DTI of 45% and in some cases up to 50% with compensating factors. But what the banks are not advertising is that the rate you are offered is significantly better when your DTI is at or below 36%. Lenders who tell you that you qualify at 45% DTI are technically telling you the truth, but they are not telling you that at 36% DTI, you likely qualify for a rate that is between 0.125 and 0.375 percentage points lower, which on a $400,000 loan is worth between $9,000 and $27,000 over the life of the loan. Run your own DTI calculation before you ever speak to a lender. If you are above 36%, identify which debts you can eliminate before applying. Paying off a car loan with a $400 monthly payment reduces your DTI and potentially qualifies you for a rate tier that saves you more money than the payoff costs. This is the kind of math that changes financial outcomes, and it takes about 20 minutes to complete on a piece of paper. Think about the cumulative financial stakes from a clear angle. The difference between a borrower who walks into a lender's office unprepared and one who has spent 90 days optimizing their credit score, calculating their DTI, understanding their LTV position, and researching float-down provisions is not a small difference in monthly payment. It is a difference of $60,000 to $120,000 in total interest paid over 30 years. That is the true cost of financial unpreparedness in the mortgage market, and that is the number you should be thinking about every time you consider skipping one of these steps. Let us talk about comparison shopping because the data on this is stunning and almost nobody acts on it. The concept is called lender competition arbitrage, and it is the practice of deliberately obtaining multiple loan offers and using them against each other to extract the best possible terms. Research examining actual mortgage origination data found that borrowers who obtained 5 or more loan quotes saved an average of $3,000 at closing compared to borrowers who went with their first or second offer. Over the life of a 30-year loan, when you account for the interest rate differences those quotes revealed, total savings climbed to an average of $11,000 per borrower. And yet nearly half of all American homebuyers get only one mortgage quote before committing. They spend more time comparing prices on a television than they do comparing quotes on a mortgage that will cost them $400,000. The reason most people do not comparison shop aggressively is fear that multiple credit inquiries will damage their credit score. Here is what the banks are not volunteering to tell you. Under FICO scoring, all mortgage-related hard inquiries that occur within a 45-day window are counted as a single inquiry for scoring purposes. This means you can apply to 10 different lenders, get 10 different quotes, and your credit score takes the same hit as if you had applied to just one. Apply to at least 5 lenders within that window. Include a national bank, a regional bank, a credit union, and an online mortgage lender. When you have all 5 quotes, call the lender with the second best offer and tell them you have a better offer from another institution. Ask them to beat it. Then take that improved offer back to the first place lender and repeat. This process, which takes about 2 hours of phone calls, routinely saves borrowers between 1/8 and 1/4 of a percentage point, which on a $350,000 loan is worth between $8,000 and $17,000 over 30 years. Now let us get into portfolio lenders and the specific loan types they offer that fall completely outside the conventional mortgage system. Most Americans think there are 2 kinds of mortgages, a conventional loan and a government loan, like an FHA or VA loan. In reality, there is an entire third category called portfolio loans, which are loans that a lender originates and holds on their own balance sheet, rather than selling to investors on the secondary market. Because portfolio lenders are not bound by conventional underwriting guidelines, they have significant flexibility to create loan structures that serve borrowers who do not fit neatly into standard boxes. Community banks and credit unions are the most common portfolio lenders and can be extraordinarily competitive on both rates and terms. A borrower who is self-employed and shows variable income on tax returns might get denied by a conventional lender, because the automated system cannot handle income that fluctuates year to year. That same borrower might walk into a community bank that portfolio lends and find a loan officer who can look at 24 months of bank statements, verify actual cash flow, and approve a loan based on real financial capacity. Another category worth knowing is called an asset depletion loan, which allows retired borrowers or those with significant assets but low documented income to qualify using a formula that converts assets into imputed monthly income. A borrower with $1 million in liquid assets divided over 360 months shows approximately $2,778 in imputed monthly income from assets alone. Most borrowers who would benefit from portfolio lending never discover these options because the large banks they approach first simply do not offer them. Research community banks and credit unions in your market and ask directly whether they portfolio lend and what alternative income documentation options they provide. At this point, I want you to see what the cumulative value of these strategies looks like in real dollar terms. A borrower who optimizes their credit score saves $15,000 to $30,000. Eliminating PMI by hitting 80% LTV saves $20,000 to $50,000. Reducing DTI below 36% saves $10,000 to $27,000. Comparison shopping 5 lenders saves $8,000 to $17,000. Securing a float-down provision saves up to $6,000. Add those figures together, and you are looking at a realistic total savings of $53,000 to $130,000 over a single mortgage. These are not hypothetical numbers. These are outcomes that financially prepared borrowers are actually achieving right now by simply knowing what to ask for and doing the work that most people skip. Let us talk about where rates actually stand right now and what the intelligent strategic response is to current conditions. As of 2026, 30-year fixed mortgage rates for well-qualified borrowers reflect an economy that has moved through a significant rate cycle. Rates are meaningfully higher than the historic lows of 2020 and 2021, but have begun to stabilize as inflation has moderated toward the Federal Reserve's 2% target. A borrower with a credit score above 760, a DTI below 36%, and an LTV at or below 80% can access rates from competitive lenders in the mid to upper 6% range. Borrowers who skip preparation are seeing rates in the mid 7% range from those same lenders. That gap of roughly 1 full percentage point between a prepared and unprepared borrower is worth approximately $62,000 on a $400,000 loan over 30 years. Here is the market context piece that financially sophisticated buyers understand clearly. In a higher rate environment, every fraction of a point you shave off your rate is worth more in absolute dollar terms than it was when rates sat at 3%, because you are starting from a higher base. A quarter point improvement at 7% saves more total dollars than a quarter point at 3%, simply because the interest dollar amount is larger. Every strategy discussed in this video is worth more right now, not less. The buyers who are winning are not waiting for rates to fall before preparing. They are preparing now so that when rates fall and they refinance, they do so from a position of maximum financial strength. There is one more concept worth your full attention, which is assumable mortgages, because this strategy alone could deliver savings that dwarf everything else discussed today. An assumable mortgage is a home loan that can be transferred from the seller to the buyer, allowing the buyer to take over the seller's existing loan terms, including the interest rate, remaining balance, and loan term, rather than obtaining a new loan at current market rates. Government-backed FHA loans and VA loans are assumable by law. This means right now in 2026 there are hundreds of thousands of homes for sale across the United States carrying existing FHA or VA mortgages from 2020, 2021, and 2022, when rates were between 2.75 and 3.5%. A buyer who successfully assumes one of those mortgages instead of obtaining a new loan at current rates instantly captures a rate difference of 3 to 4 full percentage points. On a remaining loan balance of $250,000, assuming a loan at 3% instead of taking a new loan at 7%, saves approximately $500 per month, $6,000 per year, and $180,000 over the remaining loan term. The reason more buyers are not pursuing assumable mortgages is that the process takes 60 to 90 days, and many real estate agents are unfamiliar with it and therefore never bring it to their clients. But for a buyer with the patience and financial preparation to navigate the assumption process, the payoff is extraordinary. Ask your real estate agent to flag any listings carrying assumable FHA or VA mortgages and contact the listing agent to confirm loan details before making an offer. This single unconventional conversation could be worth more than every other preparation step combined. Here is where everything comes together into a clear picture of what you now know and exactly what you need to do with it. You now understand that your mortgage credit score is different from the score on your free app, and that optimizing it to 700 or above could save you $18,000 to $99,000 depending on where you are starting from. You understand that hitting 80% loan to value eliminates PMI and saves $20,000 to $50,000. You understand that keeping your debt to income ratio below 36% qualifies you for better rate tiers worth $10,000 to $27,000. You understand that comparison shopping at least 5 lenders within a 45-day window saves $8,000 to $17,000 and does not hurt your credit score. You understand that float-down provisions protect you from rising rates while letting you benefit from falling ones, and asking for one costs you nothing. You understand that portfolio lenders and community banks offer loan structures conventional lenders cannot match, including bank statement loans and asset depletion options that unlock homeownership for borrowers whose income does not fit a standard underwriting box. And you understand that assumable mortgages on existing FHA and VA loans could deliver rate savings of $180,000 or more on a single transaction. The mortgage market in 2026 rewards preparation, knowledge, and strategic thinking. Tomorrow morning, before anything else, Pull your actual mortgage credit scores from all three bureaus using a service that provides FICO Score 2, 4, and 5. Calculate your current debt-to-income ratio and identify any debts you can eliminate before applying. Research community banks and credit unions in your area and ask specifically about portfolio lending. Commit to applying to at least 5 lenders within the same 45-day window and ask every single one about float-down provisions. The numbers you need to remember are 700 for your credit score target, 80% for your LTV target, 36% for your DTI ceiling, and 5 lenders minimum before you commit to anyone. These are your targets. Every dollar you save on this mortgage is a dollar that compounds in your favor for the rest of your financial life. Now go earn it.